portfolio, the next few minutes could legitimately save you thousands of dollars before the 30th of June 2026. Because the truth most people never hear is this: the tax system in Australia isn't built to punish you. It's built to reward people who understand how it works. And right now, with the end of financial year just weeks away, you have a closing window to use that knowledge in your favor. So let's talk about exactly how everyday Australians can legally pay less tax this year, without dodgy schemes, without fear of the ATO, and without needing to earn a six-figure salary to make it worthwhile. Here's the reality. The average Aussie worker hands over tens of thousands of dollars in tax every single year, and most of them never claim back what they're entitled to. They don't track their expenses. They don't top up their super. They don't time their deductions. And then they wonder why their refund feels like pocket change, while their mate down the road walks away with 4,000 or 5,000 back. The difference isn't luck, it's preparation. And in the 2025 to 2026 financial year, that preparation matters more than ever because the tax brackets have shifted, the rules around investment properties are changing, and a few small moves now could mean a much bigger return when you lodge. Let's start with the brackets, because you can't reduce your tax until you understand how it's calculated. For the 2025 to 2026 year, the first $18,200 you earn is completely tax-free. From there, income between $18,201 and $45,000 is taxed at 16%. From $45,001 to $135,000, you pay 30%. From $135,001 to $190,000, it's 37%. And anything above $190,000 sits in the top bracket at 45%. On top of that, most workers pay the 2% Medicare levy. So every single dollar you can legally shift out of a higher bracket or claim back as a deduction is a dollar that stays in your pocket instead of Canberra's. The simplest place to start is work-related deductions, and this is where most Aussies leave money on the table. If you spend money to earn your income and you have the records to prove it, you can generally claim it. That includes things like tools, uniforms with a logo, protective gear, professional memberships, courses that relate directly to your current job, and a portion of your phone and internet if you use them for work. Open your banking app, scroll back 12 months, and you'll almost certainly find deductions you forgot about. Think about that union fee that came out each month. Think about the laptop bag, the noise-cancelling headphones, the second monitor you bought during a busy stretch at work. Small purchases stack up fast, and most people simply forget they ever happened. Now, if you work from home, even a couple of days a week, pay close attention. The ATO's fixed rate method for 2025 to 2026 lets you claim 70 cents for every hour you work from home. That single number covers your electricity, gas, internet, phone, stationery, and computer consumables. Track your hours in a diary, a spreadsheet, or even a calendar app, and that deduction adds up fast. Someone working from home 2 days a week around 16 hours can comfortably claim several $100s without breaking a sweat. The catch is you need a genuine record. Drive your car for work? Not the commute, but actual work travel between jobs, sites, or clients? You can claim 88 cents per kilometre using the cents per kilometre method, up to 5,000 business kilometres a year. That's a potential deduction of $4,400 if you legitimately drive that far for work. Keep a simple logbook. Note the date, the purpose, and the distance, and you've got everything the ATO wants to see. Now here's where things get serious. Superannuation. This is hands down the most underused tax strategy in Australia, and it's the one wealthy people lean on every year. The concessional contributions cap for 2025 to 2026 is $30,000. That includes what your employer pays in. But here's the trick. Anything you contribute personally on top up to that cap can be claimed as a tax deduction. So if your employer puts in $10,000, you can personally contribute another $20,000 and potentially claim it against your income. Instead of paying 30 or 37 cents in the dollar in tax, that money is taxed inside super at just 15%. The savings can be enormous. And it gets better. If you haven't used your full concessional cap in the past 5 financial years, and your super balance was under $500,000 on the 30th of June last year, you can use the carry forward rule to contribute even more this year and claim a much bigger deduction. This is gold for people who've had time off work, run their own business, or are playing catch-up. But you have to act before the 30th of June because once the financial year closes, that window is gone. And remember, you'll need to lodge a notice of intent to claim with your super fund before you lodge your return, otherwise the deduction doesn't count. Let's talk side hustles for a second because more Aussies than ever are earning extra income through delivery driving, freelancing, online stores, or content creation. The good news is that almost every expense tied to that hustle can be deductible. Software subscriptions, advertising, a portion of your home internet, equipment, even bank fees on a dedicated business account. If you're earning side income, treat it like a real business from day one. Keep the receipts, separate the accounts. Future you will thank you when tax time arrives. Let's talk investment properties for a moment because the rules are shifting. Right now, you can still claim interest on your investment loan, property management fees, repairs, depreciation, insurance, and council rates. But the 2026 federal budget signaled that negative gearing on established residential properties bought after the 12th of May 2026 will be restricted from the 1st of July 2027. If you already owned your established investment property before that cutoff, you've been grandfathered in. You can keep claiming your deductions the same way you always have, right up until the day you sell. But if you're buying new from here on, the landscape is changing and you need to factor that into your strategy. A few more quick wins before the 30th of June. If you donate to a registered charity with deductible gift recipient status, keep the receipt and claim it. If you pay for income protection insurance outside of super, the premiums are usually deductible. If you've got a tax agent, their fee from last year is deductible this year. And if you hold private health insurance, make sure your level of cover is right because the Medicare levy surcharge kicks in at $101,000 for singles and $202,000 for couples in 2025 to 2026. And it can cost you more than the policy itself. There's also one strategy hardly anyone talks about, prepaying. If you have an investment loan, you can often prepay up to 12 months of interest before 30 June and bring that deduction forward into this financial year. The same goes for some professional subscriptions and income protection premiums. If you know your income is unusually high this year, this is a smart way to legally shift your tax bill down. Now, a quick word of caution. Every deduction needs a receipt, a record, or a logbook. The ATO's data matching technology in 2026 is sharper than it's ever been. They cross-check bank accounts, share registries, crypto exchanges, rental bonds, and even gig economy platforms. So claim everything you're entitled to, but never claim what you can't prove. The goal here isn't to game the system. It's to use the system the way it was designed to be used. If you take just one thing from this video, let it be this. Tax planning isn't something you do in October when your return is due. It's something you do before 30 June, while you still have the